Good afternoon and welcome everybody. My name is Kristen Biermeyer. I'm the marketing manager for Wagner CPAs, and I am so happy to have you all on the webinar today, joining us to learn about the year-end tax updates. This presentation is being recorded and I will email it to you after today's presentation along with the slide deck for your reference. We have three of our tax experts here for you today to present: Sarah Brown, John Folsom, and Swati Jain. And we're so excited to share this information with you. With that, I will turn things over to John.
Thanks, Kristen, and welcome everybody to the 2023 year-end tax update. We try to do this at least once a year, and it's geared mostly towards business topics. However, there are some individual topics as well. And like Kristen said, there's three of us presenting today, myself and Sarah Brown, who is a tax specialist out of our Milwaukee office, and Swati Jain, who works here in our Madison office. And so the agenda today, here's the agenda today. You can see there's several different items we have, and you probably saw it on the invite as well. I would say that 2023 was a fairly quiet year as far as tax legislation. There wasn't a lot of major stuff going on. So in this webinar, instead of spending a lot of time on one or two topics, it's probably going to be more of a rapid fire session of a bunch of little stuff. So I think there are important things in here that you should know. So that's why we do want to do this, even though, like I said, there wasn't any major legislation this year. But so it'll be like I said, it'll be a rapid fire of a lot of different topics. So I guess, like they say at the amusement park, buckle up, keep your hands and feet inside the car at all times, and enjoy the ride. So with that, I will turn it directly over to Swati, who is going to get us started on the 1099 updates.
Hello, everyone. For 2023, the 1099 season will start in January. And again, the due date is January 31st, 2024. And the threshold is still $600 for 1099s. The change for 2023 is taxpayers must e-file 1099s if the total number of 1099s is 10 or more, including W-2s. So don't forget to count the W-2s when you're counting the number of 1099s. And the IRS launched a new free online portal, IRIS, for businesses to file 1099 returns. The old FIRE system is no longer available, and you will not be able to e-file with that old FIRE system. We can also prepare 1099s for clients, so please let us know if you need any help.
And Swati, I believe that new IRIS system is, somebody can just Google that and find the IRS website for that. Is that correct?
Yes. So enrollment is required for that IRIS platform, and it is available on the IRS website.
Good.
For 1099K, it's an information return used to report payment card transactions, example, debit cards and credit cards. And in late November 2023, the IRS announced a delay of the new threshold, which was $600. So there is no change now for 2023. The 1099Ks will be filed for gross amount of reportable payment exceeds $20,000 in a calendar year. And if the number of transactions exceeds 200 in a calendar year. But for 2024, the IRS is now planning a phase-in threshold of $5,000. So in case you sell, a bike on eBay for $1,000, don't expect a 1099K to be issued by eBay. I also wanted to let everyone know that if you're making payments via cash apps like Venmo, PayPal, etc., these apps like the cash apps, they will issue 1099Ks to the vendors, and clients, the taxpayers, they don't need to issue 1099 NECs and MISCs for these transactions. But we would highly recommend looking at the websites for these cash apps if they will issue a 1099K or not. In case they are not issuing a 1099K, then please be sure to issue one to the vendors. Over to you, Sarah.
Awesome. So this is just a quick slide. We wanted to just show the retirement plan contribution limits for 2023 and then how they are looking for 2024. Just small increases because of adjusted for inflation. Nothing much more on that one. So jumping to the next general tax update. So we just wanted to touch base on the credit for pension plan startup costs. So the Secure 2.0 Act did expand this credit. So we get, and that starts in 2023 here, the new rules, if you will, for this credit. And that is employers with 50 or fewer employees can now use 100% of eligible startup costs to count towards the credit. This was 50% prior. And then employers with 51 to 100 employees, it's still that 50% of eligible startup costs. So the biggest change here is it was employers 100 employees to 0, all could use 50% of eligible startup costs, but now the Secure 2.0 Act updated for those employers with 50 or fewer employees. You are now allowed 100%. So jumping to the next slide here, just to let you know what is this credit if you aren't even familiar with it. So there is a credit up to $5,000 available for 3 years for eligible employers who start a SEP plan, a simple IRA plan, a qualified plan, so your 401k, your 401b3b plans. If you start that, if you start one of those plans for your businesses, you are eligible for up to $5,000 credit. And what does it take to be an eligible employer? So as we stated on the previous slide, you do have to have 100 or fewer employees who received at least $5,000 in compensation. So what that part there is saying is if you did have an employee who received less than $5,000 in compensation in the previous year, they don't count when you're doing your head count to see if you have 100 or fewer employees. Eligible employers also have to have at least one plan participant who is a non-highly compensated employee. And lastly, in the preceding 3 tax years of the employer being eligible for this credit, their employees cannot have been substantially the same employees who received contributions or accrued benefits in another plan sponsored by the employer. So really what that's saying there is the employer can't have had a plan in the last 3 years, canceled, stopped that plan, started a new plan, and then took this credit. Jumping to the next slide here, just to go over what are the eligible startup costs that are allowed to be used towards this credit. It's any ordinary and necessary costs to set up or administer the plan, and then also any costs to educate your employees about the plan. That is all allowed to go towards the credit. There is also a $500 credit for 3 years if you add auto enrollment to these plans. And then just as a reminder, the credit is a dollar for dollar reduction of tax. Next topic, we're going to talk about a little meatier here, but so Section 174 research and experimental expenditures. So we mentioned this last year because starting last year in 2022, businesses were no longer allowed to immediately expense the specified research and experimental SRE expenditures in the year incurred. Businesses now needed to capitalize and amortize these expenses over 5 years using the mid-year convention. So what does that mean? If your business had $100,000 of research and experimental expenditures, they used to just be able to take that $100,000 of expenses, deduct it from income, and end of story. No further action required. But starting in 2022, if you had $100,000 of research expenses, you now had to capitalize it, and you were only allowed 10% of that. So $10,000 of amortization expense in the first year, 20% in years 2, 3, 4, 5, and then that remaining 10% in year 6. So now what you were able to expense in 1 year is now being pushed over 6 years. for the 2022 filing season. So most of 2023, we didn't have much guidance except for what I just mentioned above. And I think most of us were also hoping that Congress would reverse these new rules, because as you can see, this obviously can be very detrimental to companies with a lot of research expense. But moving on to that next slide there, we see that in September of this year of 2023, the IRS did issue notice 2023-63. And in this notice, they stated that they give the intent to issue proposed regulations. And in the notice, it's about 45 pages long. They went through and listed out what are research activities that companies can be engaging in. From those research activities, what are the research and experimental costs, and how do those costs now have to be capitalized and amortized over 5 years or 15 years for foreign research. A lot that was in that notice, or a chunk of what was in that notice, are items we already knew that were research and experimental expenditures under Section 174. So labor costs, so wages of those who were directly performing research activities, or those directly supervising those who are performing research activities, materials and supplies used during the research activities, and then any contract research. So if you contract out research to an independent contractor or research agency, that was all listed in this notice, and those were all items we knew about. But of course, they threw some curveballs in there, and that's what I have listed out here. So overhead costs, they added in their additional compensation costs to the labor costs, travel costs, and patent costs. So this notice goes into how all of those now need to be part of your Section 174 expenses that have to be capitalized and amortized. So just a quick touch on the overhead costs, because that is really a big one. What the notice said here was, let's say you have a company who does research, and you have a research facility and a research lab in your office, and those who work in the lab, and that lab space is 100% used for research activities. What they are saying here is, let's say you have rent expense of $100,000. This research lab is 1,000 square feet out of your total 10,000 square footage office building, and it's used 100% of the time for research. They are now saying they want you to take that rent expense times, let's say, your square footage of research, 1,000 square feet over 10,000 square feet, times 100% of the time is used towards research. And that is now the portion of your rent expense that has to be included in your 174 costs and has to be capitalized and amortized. And that's for rent, utilities, electricity, repairs to the equipment used for research, depreciation. So it can be a pretty big deal. Same with the additional compensation costs when it comes to labor costs related to research. This notice stated that they plan to include payroll taxes, employee benefits, pension plans, all related to those labor costs of those working on research. So big deal here, but where we're at right now, this, as I stated, the notice came out in September. The time for submitting comments just ended just about a month ago here in November. So we're waiting for final guidance, and hopefully we see something soon on that.
All set, Sarah?
Yes. Yep. Thank you.
And I just as a comment, this, like Sarah said, I think that there were a lot of companies that got caught off guard a little bit with this. The law change was scheduled to take effect in 2022, and I think everybody knew that. However, I think everybody gets a little complacent because historically, when things like this expire or there's deadlines coming up, a lot of times Congress will, quote, fix it. They'll change the law, they'll extend it. And I think a lot of people got complacent just expecting Congress to extend this or not let this become implemented. And what happened was, you can look at the timing on this slide here. So this was effective first for the 2022 tax year. And if you think about it, the 2022 tax year, tax returns for for entities, businesses were typically March 15th or April 15th of 23. This IRS notice with the guidance didn't even come out till September. And it's kind of funny because I've heard some people say that maybe even the IRS was caught off guard a little bit, that the Congress actually let this become implemented. So it's just kind of interesting timing that, they didn't come out with any of the guidance on this till almost 6 months after the tax returns were due for that year. So I thought that was kind of interesting. Couple other, excuse me, couple other tax updates. Oops. I'm not able to move my slide here now. One moment. Well, I'm not able, oh, there we go. I'll do that. The few other things, the Section 179 expense, I think a lot of you are familiar with that. That's where you can buy equipment for your business and basically write it off in the year you acquire it. I think most people are familiar with that. The limit for 2023 tax year is $1,160,000. That's the limit of how much you can write off. There is this maximum purchase limitation of $2.8 million, which what that means is if you buy more than $2,890,000 of stuff, then that allowable write-off of the Section 179 starts being reduced, or it phases out dollar for dollar after that. So, for example, if somebody buys $6 million of equipment, they are not allowed to take any Section 179. There is the other concept called bonus depreciation, which I think you're familiar with too. And it's kind of the same thing where you can basically write off your equipment when you buy it. There are some differences between bonus and Section 179, but the big thing with the bonus depreciation is that it has been 100% for several years now. And in 2023, it goes down to 80%, meaning anything, if you buy a piece of equipment for say $100,000 in 2023 and you want to use bonus depreciation, you could write off $80,000 of the 100 immediately with bonus. And then the other 20,000 you would have to depreciate over its useful life, say 5 years or 7 years or whatever it is. So that's one change. It's no longer 100% bonus. It's down to 80% this year. And the last thing here is, for those of you who are familiar with this, we look at this for our pass-through entity clients, our partnerships and our S corporations. There is the ability to have the entity pay the Wisconsin business tax at the entity level, at the S corp level, at the partnership level, instead of having that income flow through to the owner's individual tax returns. And there's a potential benefit for doing that. So we look at that for all our clients. We've been doing that for a few years now. It's really nothing new this year, but it's still out there. It's a planning tool that we use for our clients. And other states have come online too. Wisconsin was actually one of the early adopters of this structure. So I think there was maybe 2 or 3 states ahead of Wisconsin, and Wisconsin did it a few years back. And now there's a bunch of states that are allowing that type of thing. And if that's the case, we'll be in communication with you to let you know why that makes sense for you to do. It's something we always look at for our pass-through entities. Excuse me. And then just a couple other tax updates. Hopefully you've all heard that the Wisconsin personal property tax filing is no longer a thing. It was eliminated for this coming filing season, which I think everybody's really happy about, because it was one of those things where the compliance costs, when you look at a cost benefit of how much does it cost to comply with this and all these filings and all the stuff that the municipalities had to do to process these things, compared to how much tax revenue it was generating anymore, was really just not worth it. So thankfully, Wisconsin legislature and the governor signed a bill to eliminate that for businesses. So you may have gotten your bill from a year ago recently. You still need to pay that, but the assessment date was always January 1. So beginning January 1 of 2024, you do not have to file those municipal personal property tax filings anymore, which is, I think, going to be nice for everybody. And then the last item here is the W-2 reporting. We always want to remind our clients that when you prepare W-2s, or if your payroll company is preparing W-2s, if you're an S corporation, the owner's health insurance needs to be added to the W-2 if you're a greater than 2% shareholder. And that's been a rule for a long time now. So we just want to make sure everybody complies with that. That doesn't mean that you're going to get taxed more, or that you're not going to be able to deduct this health insurance. The way it all works, in the end, you will still get the deduction for health insurance. So it'll get added to your W-2, and then on your personal return, then we can subtract it back off as a deduction. for self-employed health insurance. You may say, well, why do you go through all those hoops? Don't ask me. That's what the IRS wants you to do. There's a specific process. If you don't go through those hoops and do it that way, they actually could disallow the deduction for your health insurance. So make sure that gets added to the W-2. And then the other thing that gets missed a lot is personal use of company-owned automobiles. So if the company owns say an SUV, and then one of your employees uses it to take a vacation, for example, the mileage on that, the value of that use of the business vehicle is considered compensation to the employee, whether it's an employee or an owner or whatnot. So that should also get added to the W-2, and there's a specific calculation to do that. It's not difficult. Where I would recommend going for this type of thing, this link at the bottom of the slide, there's an IRS publication, it's called 15-B. If you just Google that, that is the IRS publication for fringe benefits for employers. And that is a really, really good summary. Every employer who has employees should have that handy, because it talks about all kinds of different employee benefits, health benefits, education benefits, gifts to employees. We get a lot of questions on that kind of stuff. So this IRS publication is a great resource to look for that kind of stuff. Now, moving on to a different topic, there's something out there now called the Corporate Transparency Act. And I don't know if anybody has heard of this, but if you haven't, you're going to need to listen. This screen is a little copy and paste from the website. In 2021, Congress passed the Corporate Transparency Act. This law creates a new beneficial ownership information reporting requirement. And then it goes on to say why they're doing it. It's because the government is concerned about all of the, what they call shell companies being set up. In the last 10, 20 years, you can imagine how many limited liability companies have been set up, and there's tiered structures, there's complex structures, and the government wants to know, right or wrong, who is behind all of these LLCs. That's the purpose of this Corporate Transparency Act. So what does that mean for you? And again, this is just another little summary. So beginning in 2024, many companies in the United States will have to report information about their beneficial owners, which means, in other words, the individuals who ultimately own or control the company. And also they need to report information about what's called the company applicants. So who needs to report on this? So the companies that are required to report, there's a term for it, they're called reporting companies. And then reporting companies are typically the limited liability companies, corporations. It says, or any other entity created in the US by filing a document with the Secretary of State. So for example, a sole proprietorship, if you have a sole proprietorship business and you've never formed an LLC or never had to file anything with the Secretary of State, you would probably not have to do this. But anytime you have an LLC or a corporation, or possibly certain partnerships might apply too, you have to consider this. There are a few exemptions for not having to file this. There are actually 23 different types of entities that are exempt. And I listed a few of the ones here. Publicly traded companies, because everybody knows what those are anyway. Nonprofits, I think the majority of nonprofits are exempt from this. So I believe anyone that's a 501c type organization would be exempt from this. And then there's other exemptions like banks and insurance companies and a few other examples. But the last one here I mentioned is certain large operating companies. And I think some of our clients actually would qualify for that. I believe the rules are if you have more than 20 full-time equivalent employees, and if you filed business tax returns showing more than $5 million in gross receipts, you may also be exempt from this. So there are some exemptions out there. And then the definitions. So who is a beneficial owner? So beneficial owners, any individual who directly or indirectly exercises substantial control over the reporting entity, or any individual who directly or indirectly owns or controls at least 25% of the reporting company's ownership interest. Now, these are high-level definitions. There's more to it than that, because you get into the question of what does it mean to be indirectly owned? What does it mean to have substantial control? So the purpose in this webinar is not to give you every single definition you need, but it's just to give you an overview. So that's beneficial owners, typically the owners of the company, to keep it simple. And then who are the company applicants? It's simply the person who created or who filed or registered the company to begin with. So how do you do this reporting? Where is it done? It's actually done through this, this is a screenshot of the website. It's called the Financial Crimes Enforcement Network. And that sounds really scary, doesn't it? And so it's it's called FinCEN, the Financial Crimes Enforcement Network. FinCEN, you may be familiar with FinCEN. We do have some experience with that because that's where if somebody has a foreign bank account, for example, that has a significant amount of money in it, that this FinCEN is the same organization or same government entity that you have to report those, what's called the FBAR reports for. And actually, Swati is one of our experts on that in our office on the foreign stuff. So you have to go to the FinCEN website. That's where you file, and it has to be filed electronically. There's no paper option or any other way to do it. And so the reports, right now you can't go on yet. They don't have it live yet. This is not 2024 yet, but supposedly on January 1st, 2024, it will be live and you can start doing it. So I guess if you're really bored on New Year's Day, you can log on January 1st with the family and see what it looks like. So the rules on how to do this, or when to do this, I should say, there's 3 bullet points here. If your company was already in existence, so if it was already created or registered prior to January 1st, 2024, you've got all of next year to do this. You have until January 1 of 2025. So there's no immediate rush to do this. You don't have to rush out on New Year's Day and do it if you don't want to. You can wait till next summer, it would be fine. Now, the other bullet points, though, if you're creating a new entity, or if you're creating a new LLC or an S Corp, if it's in 2024, then they give you 90 days to do it. And then in 2025, if you create new stuff, they only give you 30 days. And then any updates or corrections also have to be done within 30 days. And that's a pretty short time frame window. And I will mention, this is typically a one-time filing only. You don't have to do this every single year. This is generally a one-time filing. However, anytime anything changes, like it says here, you have to update it within 30 days. So if the owners change, if your address changes, things like that, it still has to be updated. There are penalties for not doing this. You might think, well, do I really need to bother with this? There are penalties up to $500 per day for not doing this, up to $10,000, and imprisonment for up to 2 years. Now, I'm hoping that for somebody with a little LLC that, you and your sister have an LLC for the family cabin or something. I'm hoping they're not going to come and throw people in prison for not doing that, but it's in the law that these are the potential penalties that can apply. And then you may also be wondering, can Wagner CPAs do this for you, or will we be filing this on behalf of our clients along with our tax preparation? And the answer is no, we're not going to actually be able to do this for you. We are only allowed to do certain things, and this is really into the area of more of a legal matter. So, for example, if you come to us and say you want us to file your articles of incorporation, we can't do that because that's a legal thing. This is more of a legal thing as well, and I think most CPA firms are taking the position that we just aren't allowed to do this kind of thing. I'm hoping that for a simple structure, if it's just you and your sister owning an LLC here for one thing, I'm assuming you can probably navigate this yourself fairly easily. If not, if you have a more complex structure, if you just don't want to deal with it, we do recommend reaching out to your attorney to help with this. They should be able to help with this. And then the last thing on this Corporate Transparency Act, if you're wondering about this whole thing and what are the definitions and how do we do it, on this FinCEN website, there is something called a Small Entity Compliance Guide. And it's 57 pages. And it's really good. It's got all kinds of Q&A type things, like who needs to do this and when do you need to do it and how do you do it and who's a beneficial owner, what are the definitions. So I highly recommend anybody who's got an LLC, corporation, partnership, any kind of business entity out there to go look at the Small Entity Compliance Guide. I think it'll help a lot. Excuse me. And I think with that, I will turn it over to Swati, who's going to give us an update on the solar and electric vehicle credits.
Thanks, John. So for solar and electric vehicle credits, we'll start with the energy efficient home improvement credit. This credit effective from 2023 to 2032, it jumped from 10% to 30% of the cost of certain improvements. And so homes used as residence qualify, and it doesn't mean that it's just the primary residence. Other residents, other homes that you have also qualify. Annual dollar limit apply, which is generally $1,200 per year, but for heat pumps, biomass stoves, and boilers, they have a separate annual limit of $2,000 per year. So this is all for the energy efficient home improvement credit. And then there's residential clean energy credit, which is extended through 2032. It's reduced, so it's basically 30% of the cost, and then it is reduced to 26% for 2033 and 22% for 2034. So whatever the cost of your improvement is, 30% of that cost is the residential clean energy credit, and it includes solar electrical systems, solar water heating systems, wind, geothermal can qualify, and then battery storage systems with capacity of at least 3 kilowatt hours is these all qualify for residential clean energy credit. Then clean vehicle credit for 2023. So we'll start with the new vehicles first. There is no sales caps by manufacturers anymore. And there is a requirement that the final assembly must be in North America. There are other sourcing requirements for critical minerals and battery components. The amount of credit is for new vehicles is $7,500. And there is a maximum selling retail price cap of $80,000 for pickup trucks, vans, and SUVs, and for $55,000 for all the other vehicles. So if the cost exceeds these costs, then the credit reduces. Then there is income caps, $300,000 for joint filers, $225,000 for head of households, and $150,000 for single filers. So if you are under these thresholds, then you can take the $7,500 credit for the new vehicles. For used vehicles, it's the lesser of $4,000 or 30% of the price of the vehicle. This is for used vehicles. Price must be under $25,000 and the vehicle must be at least 2 years old. It must be sold by a dealer, so third-party sales or private sales are not allowed. So if you're buying a vehicle off of Craigslist or something, that is not allowed for this tax credit. There's no sourcing requirements, and there are income caps for this credit as well. It's $150,000 for married filing jointly, $112,500 for head of household, and $75,000 for single filers. So anything under this, you can take the maximum credit of $4,000 or 30% of the price of the vehicle. Then there is residential electric vehicle charger credit. That's 30% of the cost of the charger and installation, or a maximum of $1,000 of credit. So it includes both the installation and the cost of the charger. And then beginning January 1 of 2024, consumers, or basically the buyers, can choose to transfer their new clean vehicle credit of up to $7,000, $7,500 or $4,000. Instead of taking the credit on the tax return, they can choose to transfer it when they're buying the vehicle. So basically, it'll reduce the price of the vehicle at the point of sale. This will effectively lower the vehicle's purchase price, but the EV dealers, they need to enroll with the IRS energy credit online tool to extend this credit at the point of sale. So if a dealer has not enrolled in the IRS energy credit online tool, then they will not be able to extend it at point of sale. So, but for this, we would recommend thinking about it first if you're under the AGI threshold, because otherwise at tax time, then you will have to repay the credit back. Over to you, John.
Thank you, Swati. I drew the short straw, so I'm going to talk about the ERC update here this year. The ERC has been around now a few years, and we've been over this. You've heard of this everywhere in the news, and it was. I've got kind of an update here. I'm not going to go through all the specifics of what it is and everything, but I think I maybe just speak for myself, but the people listening on this webinar, you're probably kind of sick and tired of hearing about ERC, because if you remember, I'm sure you remember, in the last year or two, we've just been inundated with radio commercials and internet ads, and every time you turn on the radio, you're hearing about, oh, get your $26,000 per employee, and so I think everybody's just growing a little bit sick and tired of hearing about it, and we're not the only ones who are sick and tired of hearing about it. The IRS is actually sick and tired of hearing about the ERC too. This is a screenshot. Every year, the IRS comes out with something called their Dirty Dozen. And usually it's related to tax promoter schemes or some kind of obscure, complex tax structures that are really not legitimate. The 2023 Dirty Dozen summary, number one is the employee retention credit claims. And so the IRS is really, I would say the IRS is very cranky about this whole ERC thing right now. And so this is just a screenshot from the IRS website. Taxpayers should be aware of aggressive pitches from scammers who promote large refunds related to the employee retention credit. The warning follows blatant attempts by promoters to con ineligible people to claim the credit. The IRS highlighted these schemes from promoters who have been blasting ads on the radio and the internet touting refunds, blah, blah, blah. So the IRS is getting very cranky about this as well. And in September of 2023, this is another screenshot, they came out with, or they basically put a big timeout on this whole thing. They said, all right, based on everything we're hearing, all the stuff we've been getting, they were just swamped with applications on this stuff. And it was fairly obvious to them that a lot of these were fraudulent. And so September, they just said, okay, timeout. We are not processing any more of these through the end of the year. And that doesn't mean that if you still qualify, you can't do it. I mean, we can still file for the ERC if for anybody who qualifies. They're just not going to process it until 2024. They need a time to figure out what's really going on with all these promoters and things like that. So that happened in September. This is one more screenshot from recently in December. The IRS expands work on aggressive employee retention credit claims. 20,000 disallowance letters are being mailed, and more action and voluntary disclosure programs coming. So the ERC is, and maybe let me back up, maybe before I get into the penalties. This might be a good time just to mention that Wagner CPAs prepared and filed a lot of employee retention claims for our clients. And when we did that, we were very clear and very bright line test that if you qualified, you qualified. And so if you had us do your ERC claim, you don't need to worry about this, because we looked at it, we made sure you met the tests that were required to be eligible. So don't worry if we did it for you. But if you went out and had one of these radio ad companies do it for you, you better let us take a look at it or have somebody qualified take a look at it, because if you don't qualify, or if you didn't qualify and you just let one of these promoter companies do it for you, and it turns out you didn't qualify, you really do need to pay it back. And the reason is, number one, it's the right thing to do. And number two, there are a lot of penalties that could apply to ERC claims. And like I said, the IRS is very cranky about this, and they are, I guess I would say I've never seen the IRS just so involved in something like this, where they're just coming out with stuff like this. So they're just sick and tired of hearing about this, and that they feel not everything, but there's a lot of fraudulent stuff going on. So it's been a little bit eye-opening for me too. But this is a list of all the potential penalties that could apply. Interest and other penalties, potential fraud-related penalties. There could be criminal charges if there was a completely fraudulent return. And the last one here, just to mention, this section 6672 trust fund recovery penalty. These ERC filings, these are payroll tax return filings. And when payroll taxes are filed, this trust fund, they're considered trust fund type tax. So this trust fund penalty could apply. And what that means is, instead of the penalty applying just directly to the company, so if you have a corporation, instead of it just being a corporate penalty, they can actually come after individuals personally liable for owners, officers, people who are responsible for this type of thing. So it's not something that you want to mess around with. And I think that in a lot of cases, by the time so let's say you took $200,000 of ERC credit, and it turns out that you were not eligible for it, and the IRS is going to start applying some of these penalties. Not only are you going to pay the $200,000 back if you get audited, that could very well turn into double. That could turn out to be $400,000 by the time all these penalties apply. And not to mention that all the money you paid to that promoter company, you're probably never going to see that again, because those companies are probably long gone and closed up. So just don't take this lightly, because the IRS is not taking this lightly either. So if you had one of these companies go out and get ERC for you, just make sure you know why they did it or how you qualified, or have us look at it, because we don't want our clients getting in trouble. I think the majority of our clients, they came to us and we did it for you. And again, if we did it, we're comfortable with it. Don't worry about it. But if one of these other companies did it, you might want to think twice about it. The one thing they did come out with is there is a way to withdraw a claim. And so in only certain circumstances. So if you filed a claim for an ERC, but you have not received it yet, you have not received the money yet, or if you got the money, but you haven't cashed the check or deposited the check, there is a process you can withdraw it if you believe you should not have gotten it. So just be aware that that's out there. Now, what if you actually did receive and deposit your ERC refund, but now you're saying, gee, I probably shouldn't have? Then at this point, the IRS is supposedly working on a process for allowing you to withdraw that, but we don't know that at this point in time. That's about all I want to say on the ERC. So I'm going to immediately turn it over to Sarah with our time remaining. She's going to talk about what's called the sunsetting provisions. Okay, Sarah?
Yes, all right. Yeah, so our last topic here is just talking about the 2017 tax law, which was, you might also know it as the Tax Cuts and Jobs Act. It was enacted in 2017, but took place, all the provisions took place starting tax year 2018. And within the Tax Cuts and Jobs Act, they set an expiration date for a lot of these provisions. So they were set to expire 12/31/2025. So we're going to go into some of those and talk them through. But I do have to note, of course, as tax is ever changing, as I know everyone is aware. So as of right now, these are the provisions set to expire. But as we get closer to the 12/31/2025 end date, I wouldn't be surprised if we start hearing some talk of certain provisions being extended for a year, 5 years, 10 years, or even being made permanent. But for the time being, this is what we're looking at. So the first one, I'm just going to touch on this briefly because John mentioned it earlier as well, that the bonus depreciation, the 100% bonus depreciation allowance that was in effect is now starting to phase out. So we'll have 80% here in 2023, and then it'll knock off 20% every year until 2027, where there'll be no more bonus depreciation allowed. We're not thinking this is going to change or this is one that will be extended, etc., especially for 2023. It's pretty certain it will stay at the 80% allowed, and it will continue to phase out through 2027. Next up, we're going to talk about, it's not really a sunsetting provision, but has to do with the Tax Cuts and Jobs Act rules. So the meals and entertainment. So just background history, when TCJA came out in 2018, it really redefined what the meals allowance was for tax and what the entertainment allowance. Those used to be really intertwined, and they set more definite definition. So what were you allowed as a meals expense 100%? What were you only allowed 50%? And then what were you allowed 0% or nothing at all for the meals and for entertainment? Then we hit COVID, the pandemic, and many COVID acts came out. And in one of those acts, we were allowed to 100% expense any meals expenses that were purchased from a restaurant. So we were allowed that for 2021 and 2022. So it's coming back here now, starting the 2023 filing season, we have no longer have that 100% allowance, and we're going back to the TCJA meals and entertainment. So I've just listed out some common meals expenses that are now back to that 50% allowed. And then jumping to the next slide, I just touch on entertainment expenses. These are still have been 100% not allowed, non-deductible. And I list out some common examples of those that aren't allowed. So sporting event tickets, golfing with a customer, concert tickets. If meals, food, and drink are separately stated on those invoices or receipts, you are allowed 50% of those food and drink as long as they're separately stated, but the actual sporting event ticket, the golf price, etc., are not allowed. So jumping back to items that are actually sunsetting, 199A, this was widely talked about when this came about in 2017, 2018. So this was that 20% deduction at the personal level for those who had pass-through entities. You were allowed the 20% deduction of your qualified business income. So currently this is set to sunset after 2025. Next up, we have the lifetime gift exclusion. So right now I've got listed out there what our current amounts are at. So for 2023, we have 12.92 million for the lifetime federal gift exclusion. In 2024, it's at 13.61. So with the sunsetting, come 2026, we're going to revert back to what it was pre-TCJA. And that was 5 million. So it'll probably be adjusted for inflation, which they're estimating to go back to about 6.5 million for the lifetime federal gift exclusion. The annual federal gift tax exclusion, that nothing is changing there. I just wanted to throw that on there so you were aware of the amounts for 2023 and 2024. Those will continue to just slowly increase, just being adjusted for inflation every year. Next up, so these are just other items that are going to impact individuals that are set to sunset. The marginal tax rates will revert back to the old rates. Again, everything adjusted for inflation. You can, if you go out and you can even Google it, there's estimates out there of what they are estimating it to look like with inflation right now, what those rates would look like. But of course, we don't know the set yet, the set amount. So the standard deduction is also set to reduce. So if you remember, back in 2017, we had a lower standard deduction, but we had personal exemptions. And then TCJA came back, they got rid of personal exemptions and they hiked up the standard deduction. So that is set to go back to how it was, again, adjusted for inflation. And as you also know, one that was it affected many taxpayers was the SALT cap of 10,000. So the state and local income tax amount that was allowed as an itemized deduction was capped at 10,000. That is set to be lifted. Other deductions that were not allowed under TCJ that may come back when this sunsets is unreimbursed employment expenses, investment expenses, investment fees, tax preparation fees, hobby expenses limited to hobby income. And then, of course, though, with all these deductions, the PEAS limitation is set to come back. And that PEAS limitation is a way to limit high income taxpayers, limit these itemized deductions for them. So I read something funny. It was that the IRS give it, the IRS take it. So they'll bring these deductions back, but in that same breath, the PEAS limitation will also come back. So that is all I've got, and that concludes our webinar. Thank you everyone for joining on. I hope you grab some good tidbits of information here.
There are a couple of Q&As that
A few questions.
you can read. So if anybody wants to leave, I think we're pretty well done, but we will stay for questions if anybody wants to ask any questions. There are a few questions here. If business is closed by the end of this year, no need to do a Corporate Transparency Act report. Again, that I don't know 100% for sure. My guess would be that you probably don't need to do it if the business is closed and ended and in 2000, if the articles of dissolution and everything were filed in 2023, my guess would be you probably don't need to do that. So, and let's see what else. Answer. Does that mean they would stop processing applications? Oh, the ERC, this is probably the ERC. Does that mean they would stop processing applications submitted before that date? Yes, if they received anything that they hadn't finished processing yet, they put a hold on. So it wouldn't surprise me if you have to wait longer to do that. So like I said, if it's a legitimate application, we're still confident that you'll still be able to get your ERC. It's just going to take longer. So we are happy to stay longer if anybody wants to ask questions. Kristen, do you want to take control or?
Yes, thank you, John, Sarah, and Swati for sharing your expertise today. That was an excellent presentation packed with tons of great information. Once again, I'll be sending the webinar recording and the slide deck to everybody to reference later. And it will also include contact information for our presenters. So if you think of follow-up questions afterward, you can contact them after that. If you're not already on our email list, make sure you sign up for that. You can go to wagnercpas.com. There's a link at the bottom of every page to sign up for our email list. So you get invitations to our upcoming webinars. And that's all we have for you today. So thank you again for coming, and we hope to see you all again soon.
Have a great day.